Welcome to our 2022 Mid-Year Economic Outlook, and thank you for joining us. I'm Greg Askey, one of the principals at Matthews, Carter & Boyce, a CPA firm located in Fairfax, Virginia. For the past 8 years, Matthews, Carter & Boyce has been hosting a complimentary economic outlook for our clients and friends in January. However, with so much economic uncertainty in 2022, we thought it was imperative to bring Dr. Terry Clower back to share his insight on the national and local economy for a mid-year update. Before I turn it over to Dr. Clower, a few housekeeping items. The presentation and Q&A are scheduled for an hour and a half. Please submit your questions via the chat feature. At 1:30, we will invite you to turn on your cameras for interactive networking with Dr. Clower for 20 minutes. In the coming weeks, we will send an email to all registrants with a link to the summary recording of his presentation. Our esteemed presenter today is Dr. Terry Clower. Dr. Clower is the Northern Virginia Chair and Professor of Public Policy at George Mason University and is also the Director of GMU's Center for Regional Analysis. The center provides economic and public policy research services to local governments and businesses, primarily located in the Washington, D.C. metro area. Perhaps you read his recent quotes in the Washington Post regarding the economic impact of Boeing's HQ move to Arlington and Amazon's HQ2. Today, Dr. Clower will provide us with insights into economic trends in Northern Virginia, the greater Washington, D.C. area, and across the country. Now it is my pleasure to turn the presentation over to Dr. Terry Clower.
Thank you very much, Greg. Appreciate it. And welcome to all of you here. We're happy to have you with us today. As Greg mentioned, we're going to move through pretty quickly an overview of what's going on at the national economy, regional, as well as, talk about even some fairly specific local impacts and effects that's happening. Obviously, there's a lot going on in the economy. We are going to cover many of the same topics that we did in the January presentation, so we can think of this as a little bit of a look back. What's changed? What did we get right? What did we get wrong? So we're gonna move through this pretty quickly. I certainly will look forward to having your questions and engagement at the end. Because of the number of slides we're doing, we are going to go through this pretty straightforward. Just run through it, but note down your questions as you have them, pop them into the chat, however you're going to get those to us, and we'll be happy to address those questions to you. So let's look at the big picture. So the thing that of course we talked about in January is that we had a huge downturn in the economy when the shutdown due to the pandemic happened, and of course that lasted honestly a very short period of time, and we saw a rapid recovery of much of that loss, but not all of it. As you can tell from the chart, we have now grown, at least we have recovered. The total level of US GDP is higher than it was when the first effects of the pandemic were noted. But we're still below that trend line, if you will, of where we would have been otherwise if we'd have continued that fairly steady growth that we had for a long run period since we started recovering from the financial crisis, the Great Recession, if you will. Having said that, the media had a field day, and of course, markets started going a little bit crazy when we got the first estimates of first quarter 2022 GDP growth, which came in at a negative 1.4% on an annualized basis. I think that we need to put some of that into context. So let's take a look at some of the components of that change and talk about how some of this moved through. So while the headline number is down 1.4%, there are some good news pieces in here and some pretty obvious things that are happening external that doesn't necessarily signal that the economy is as weak as you might expect from a drop of more than a full percentage point. Personal good expenditures here, that 1.83%. Personal consumption expenditures still represents about 70% of our economy, and that still grew Now, not as fast as we had seen, of course, during the recovery. You noticed back in the first quarter and second quarter of 2021, very high growth rates, but that started paring down toward the end of last year. But that actually increased over what we were seeing in the second half of 2021. So that's actually pretty good news, if you will. We saw some real impacts from net exports of goods and services. Our exports were down a little bit. That can be attributed in part to some of the conflicts that are going on in Europe, the Ukrainian war. There are some other factors with that. I would see that increasing as our capacity to ship natural gas to Europe expands and we get more vessels that are actually in that pipeline of shipping natural gas produced in this country and transported to Europe, as Europe has started to try to unwind their positions of purchasing from Russia. But you'll also note that imports, now that shows as a negative number, that's because it's a detraction from GDP, but our imports increase, which gets back to some of those personal consumption expenditures. We are buying more and more goods from overseas, and that has risen. And as that rises, then that takes a net 3.2% off of GDP growth. So there's a bit of an artifact there, if you will. There are some other elements that I don't highlight that are buried in some of these numbers that I think are worth talking about a little bit, and things that I think you will say, oh yeah, I recognize that. Part of what we saw in the first quarter numbers was continuing drops in private inventory investments and some government spending. Now, the government spending, of course, we'll talk more about that in a little bit, but that can be related to the winding down of many of the pandemic-related spending programs. The other, though, on the inventory is one that as we drive around town, it becomes obvious. Drive by any auto dealership and how many cars do you see on the lot? The reduction in inventory being held in the form of automobiles at wholesalers or retailers has dropped substantially. And that is pulling down GDP growth numbers just because it becomes an artifact in the data. Now, one of the things that I think is interesting, and we will actually talk about this a little bit more later, I have a real sense, and I'm starting to get a sense of what I am reading in the industry press about manufacturing, that Ford, GM, these major companies are really liking this notion that they have basically little inventory sitting on these lots because, for example, if you ordered a Ranger pickup truck, that small truck that Ford produces, back in February, they sold out of the year's production. So people buy these things. It's kind of like the Tesla thing. You put a deposit down, and then you wait several months for the car, and that car doesn't actually ever really sit on a lot in a for sale condition. And they're looking at their numbers and saying, gee, do we want to go back to the day where we had, hundreds of vehicles sitting on an individual lot that were just basically, capital sitting there? So it may be that in the future, we're having to readjust how those inventory factors contribute to our actual measurement of GDP, because we may not go back to the days that we saw where you just had the companies producing to keep the factories running, and then producing product that wound up just sitting for months at a time on a dealership or a wholesaler lot. I mentioned the government programs that are winding down a little bit. That obviously includes some of the business programs on forgivable loans. But I think what we see here is, broadly speaking, some factors that have been negative, but show conditional drops, not necessarily signs of overt weakness in the economy. And I'll point to some other data about that in just a couple of minutes. As we move in and we're looking at job growth, again, you have that gap. We haven't quite recovered to where we were in pre-pandemic levels in February of 2020. As you can see, we're still below that line a bit, but we've had pretty solid job growth. In fact, the April number at 428,000 jobs for the month which matched March's number, was much higher than most analysts were expecting. And part of it was you had those early releases of the first estimates of first quarter GDP growth. And it's like, oh, well, then job growth is going to slow. Job growth continued on. I think this is an interesting little artifact about our economy right now. GDP declined 1.4% in the first quarter, but during the first quarter of this year, the US economy created 1.6 million jobs. So that's not exactly this stagflation story that you have coming out. I'm not saying there's not a risk of that, but I think we have there's some artificial things happening in that data that means that maybe we're not as weak as some of the markets are trying to indicate for us. Again, job growth, we're still recovering from some of the shutdown. And in some cases, we've seen shifts and changes in the productivity and the way we're doing business. You think about restaurants that continue to have trouble finding employees, they're having to change the way that they do business that may require fewer employees moving forward. The other thing that we are going to see that I think is going to start kicking in is that we now have the rising wages. We've seen, of course, some areas have gone to $15 an hour minimum wage. And when you do things like that, you are making it more cost effective for employers to employ labor saving technologies. We've talked about this before in other presentations. But if you think about this, the chances of you actually engaging with a live individual, if you're going to buy a hamburger at McDonald's, is getting smaller and smaller and smaller. And that's going to be two factors. One, if minimum wages rise to the point where technology is effectively cheaper, and if you add to that basically tight labor markets where they can't find the workers anyhow, then we're going to see that labor substitution effect, which actually at some point puts a little bit of a damper on payroll job growth. We just haven't seen that yet, but in part because we're still catching up. The unemployment rate continues to drop down. We're down, April numbers, we're down to 3.6% for the headline number. That U6 number, those of you that have been to these events before, when we've done the annual event, that difference between the unemployment rate, which is the U3 rate, and the U6 rate that I have there, is that difference between, let's say, the biggest hunk of it are folks who are working part-time but would rather be working full-time. And as you can see in the long run trends, that differential between the lighter green and the darker green had narrowed up until that time. It expanded a lot, ballooned out, if you will, a little bit after the shutdowns due to the pandemic, but we're starting to see that gap narrow again. As you can see, we're actually dropping a little bit. The bottom chart, the labor force participation rate, is one that is critically important for our long-term economic health, particularly as government assistance programs are wound down. And many of those have already stopped now, but you think about, we have a lot of folks, we still have not recovered back to where as many people were participant in the labor force. Now, some of that is because of retirement, the baby boom generation getting older, retiring. But I would tell you that, in my view, a good hunk of this is still the disruption, particularly for single parent households with children, or actually even dual income households with children, because the children's schooling, whatever they were doing, was disrupted. Let's face it, until a few months ago, we were still having this thing where one of the kids in the classroom starts sniffling and everybody in the class gets sent home. Now, that's not so much happening now, but it's still kids getting COVID. And I think of our neighborhood kids in where I live, they're still popping up with COVID now, and they may be back in school another, 7 days later, but they're at home and somebody's caring for them while they're at home. So we continue to see some pressures on that. It has risen back up, but you'll notice that our last data in April shows a little bit of a downturn in that. So we lost a little ground. Our big effect here is getting people back into the labor force, back participating. There's another factor that we're starting to see now is folks that maybe retired a year and a half ago. They actually took retirement. are now looking maybe to enter back into the workforce, if not on a full-time basis, at least part-time. And I am very much a supporter of encouraging folks to do that, to bring their talents back into the market and get our overall production levels up, because we do have companies, and maybe some of you are experiencing this, that if you simply had more workers to fill what you need, your total production, your total sales could be higher. But this remains a real challenge, and we need to see about getting that gap rising. So if we start looking at some industries, there's two pieces of data here. We're looking at the 12-month change in jobs by sector, and then the number in the little red box is still where we at in number of jobs expressed in thousands compared to what we were in February of 2020. So the month before we really started seeing the business impacts of the pandemic. So education and health services, and when I say education, remember that this is private sector education. So public schools, public universities are not in there, but education and healthcare services are up, but they're still down from pre-recession levels. That is still largely in the health services. We are still, even though many of the clinics have opened back up, they are not operating back at full capacity yet of what we were seeing pre-pandemic. And a lot of that is not so much around the hospitalizations. As we talked before in previous presentations, you had this odd thing that we had a health crisis emerge, but it actually wound up reducing in lower number of people employed in healthcare services because elective procedures basically stopped during that period. They have started up again, but it is a ramp up. It's not back up to full activity levels, pre-pandemic levels, I should say. Professional and business services added, almost 1.2 million jobs year over year as of April. So that sector has done pretty well and is about 660,000 above. And remember, and we'll talk when we get in the regional level about that differential between the professional side of those services and then more of business services to buildings, things like that. We talk about that and we'll bifurcate that down at the regional level. Leisure and hospitality is up almost 2 million jobs, but still down another 1.4 roughly million jobs. So we still have not seen that recovery. We would see the indication still for leisure travel is doing well, but business travel is still somewhat constrained, as we can tell. There are many positive signs out there that we're starting to see. One of the things, and we'll talk about this more in just a moment, is that obviously this is going to be a very, very busy travel season. I think particularly for leisure travel, even with higher gas prices. And we'll talk more about that in just a few minutes. Retail trade is up some. Manufacturing is up year over year, but has not recovered yet. And this is due still to lingering supply chain issues. I think it has more to do with it than anything. And I think that's going to continue. You don't have people working if you don't have the materials for them to work on. Financial sector up, construction sector is down a little bit. And this again can be related to materials and cost of materials that we've seen. So there's again supply chain disruptions and costs, although we continue to see a lot of construction activity that's actually pulled back a lot of back, and our permitting processes for getting new starts going on is not performing where we need it to perform, particularly in this region. Transportation utilities up, that doesn't surprise anybody because of our online retailing. How many times it's not a matter of how many times a week Amazon is showing up at my house. It's how many times a day now. And, and as we get more into it, and some of us have even got to where we actually like not having to go to the grocery store. We're happy to let the clerks do our shopping for us and just deliver it to us. So we'll see. You'll note that federal government is down. That's still a little bit higher than the beginning. The big difference there, and the reason federal government down is largely on a year-over-year basis, is still because of a little bit of the holdover from the census. And after they do the census, they still have a lot of people who are doing the analyzing the data and all of that. But so federal is basically flat, not changing a lot. Average weekly earnings are rising. You folks know you're winding up, you have staff that you're having to pay more to keep them with. Unfortunately, what we've seen is that when adjusted for inflation, because of overall inflationary prices going up so dramatically recently, we're actually losing ground in our earnings, which is going to still, as long as inflation is high, is going to cause folks to be coming to you saying they won't hire pay. So we are going to see this real challenge. And of course, naturally, as you well know, as you start paying more in wages and salaries, at some point you have to pass those expenses along. So it contributes to inflation. And this is part of it. We'll see some more evidence of other factors in a little bit. But again, the good news is wages are rising. And if you look at the slope of the line since 2020, that line the dark green line has started to slope a little bit higher up, rising faster. But again, we're losing ground in real terms. Now, we continue to look at this, but this is a very specific piece of data that's asked in a very specific way. So the number of paid employees that are working at home due to the pandemic has dropped. And in fact, it continues to drop down. That we see the April preliminary number was just released, didn't have time to update it, and it's down a little bit further. So we had another drop, not as big as the drop from February to March, but another drop to April. We continue to see that. Though, this will maybe the last time that I show this slide to this group, unless we have another surge in the pandemic, because that does not mean that all these people are returning back to the office. We have switched into this whole notion that work from home, at least in a hybrid mode, if not fully remote, is an increasing just way business is being done at the moment, even though we do have employers that are doing their absolute best to force people back in the office. It's just unclear about how successful they're going to be doing that. And indeed, talk about remote work. I presented most of this data, this slide, back in January. The company that produced this data, the Ladders, which is an employment services provider, they have not done another study. So we put this up just for those of you, just as a reminder, and for those of you that are joining us for the first time. So the level of remote work, and particularly for this survey, it's 100,000 a year and above salary. So these are relatively higher end jobs, is just an exploding phenomenon. Prior to the pandemic, 4% of the workforce could be considered remote. Some of these were traditional things. You think about regional sales managers, things like that. You saw some software engineers working remotely before, but it wasn't that big of a workforce. Now we're talking at the end of 21, that jumped to 18%. And in fact, it's probably still rising. I put this number that I pulled up just a couple of days ago, actually, on this website for the Ladders. They currently have almost 48,000 job listings that are specifically fully remote jobs. The employer has no expectation for the worker to be in the same location where the rest of the business is, at least on a recurring daily basis. So I think that is an interesting phenomenon going forward. Labor productivity, long-term driver. We've seen a couple of downturns in recent months. I think that I'm just not overly concerned about these two most recent little downturns, because you're going to get there are all sorts of disruptions going on. The supply chain issues impact productivity. When you bring on new workers, you finally get somebody trained up, or somebody graduates and you get them onboarded and you train on. If you think about it, your average productivity declines a little bit, because there was a continuum of work growing where your existing employees were just getting the job done, even if it required extra hours, extra effort, whatever. So our productivity numbers are, as we are seeing employment grow back up to that levels, maybe a little bit constrained just in a numerical sense, the numerator versus the denominator. Having said that, the greatest contributor to labor productivity is technology. And you've heard me say this, so I'm going to repeat what I have said before. There is no nation on this planet that is better at creating new technologies, at deploying those technologies, and adopting technology. Now, what we have in some parts is that some of that technology, like we mentioned before with in say fast food, some of that technology is labor saving technology, which can from time to time put strains on labor growth, on demand for labor. Having said that, in the long run, the productivity is our driver. If we slow down in productivity over a long period of time, over a few to several year period, that's when our competitors can catch up to us. And we want to be still the best. That gets back, and when we talk about interest rates, why is money still flowing to the US? Because where else in the world would you put your money as an investor? Consumer confidence. Well, let's say that we have certainly been on a bit of a roller coaster ride about how we view our present situation. And remember, this is a household survey. So they say, how do you feel about things at the moment? How do you think things will be in the future? There's several other questions that help unpack that. But what was really interesting is throughout the pandemic, you'll notice that green line, you know, it's bouncy but it has a little bit of a downward trend, but not bad. Our expectations seem to have held up pretty well throughout the pandemic for what will happen in the future. We, of course, though, saw the immediate impact and the immediate disruptions. Now, what was interesting was that all of a sudden in 2021, boom, we feel a lot better about the current situation. And I think that's because in many respects, I think on average, we've gotten over the pandemic. It's not that we think the pandemic is over. We've just gotten over it. And we are going to go ahead and behave. And I know there's a lot of risk to this, but, you know, it's kind of like, you know, you talk to folks, we have a little bit of an outbreak going on at George Mason, at least in my school. And I've gotten notices about colleagues who have gotten sick in the last, you know, few weeks or whatever, or quite a few more than we had during the height of the pandemic. But they're, you know, they seem to be, you know, not having severe impact. So they're back on the job in a few days, if you will. So I think we are just seeing some artifact of that. Now you'll notice that the stock market volatility and the news being bad and all this has started to pull down the present situation, if you will, the feelings about that. I am also concerned a little bit about that recent trend in the expectations index of dropping down a little bit. It did not really drop much between March and April of this year. So it kind of pretty much, if you will, stayed the same. The recent drop that we've seen, though, in the expectations index is directly tied to gasoline prices and the war in Ukraine. This is part of their survey work. We do see that rising gasoline prices are starting to have a little bit of a cooling impact on vacation intentions, a little bit of an impact. You have some households that are starting to say, maybe I won't drive, you know, all the way to Florida. Maybe we'll go to the Outer Banks instead. So, you know, there's some things like that are starting to play out in the economy, which kind of makes sense. Unfortunately, I'm concerned regionally about that impact on vacation planning and how it might influence the people who are coming here to spend money. So we're still needing to see that tourism sector and indeed business travel spending both increase. But obviously what we've seen more recently, I think most of the time around what would have been the usual cherry blossom festival period showed to be very active. You know, more people coming in. Certainly at the airport, you were starting to see a lot of kids show up with their spring break field trip kind of t-shirts on and things like that. Interestingly, in contrast a little bit to what we're seeing in that expectations trend, the surveys did report an interesting little thing that folks are rising in their expectations of making some major purchases, like buy a car, assuming if they can find the one they want, and other big ticket items like appliances and stuff like that. So that still kind of bodes well for stabilizing that. There will be some little trends, but it doesn't show like that an impact for expectations goes out. And that then goes back to what we were talking about earlier in consumer spending. If you expect that your future economic situation is going to be okay, you're not expecting major disruptions, you may not see a major uptick, but you're not seeing a major disruption on the horizon, then you're more likely to go out and purchase bigger ticket items. prices, consumer inflation. So we're going to go through a couple of slides on this. This is annualized data, and so it just reports the year average. And of course, within what's happening within the year is important. We wound up the year for 2021 at somewhere around 4.6, 4.7% year over year inflation, which that's high by recent standards. Certainly there's some of us that remember when things were a lot worse a long time ago, but by our standards that we've kind of become used to, it's pretty high. And in fact, it's going to get worse. If we look at this more on the monthly data, you can really see where right at the moment, our most recent measure is that consumer prices are up 8.3% year over year. Food is up 9.4%. These are April numbers. Energy is up 30%. Other items, 6.2%. We were talking about travel earlier. Airline tickets are 33% higher than they were this time last year for the same destinations. So this is obviously something that's a real challenge. I had a prediction that we'll review earlier about what I thought the year would happen. I would tell you that my expectation, I'll remind you at the first of the year, was that if inflation was still running at 4.5% to 5%, in November, that it was going to be disastrous for the administration's party, that the Democrats are going to take the hit, if you will, for this. It's not their fault, by the way. We can talk about that in the discussion sessions. I think a large part of my concern, though, is we're not done with the cycle of rising prices. Certainly, there are some things that are happening there where releasing strategic petroleum reserves, where they're talking about other measures that they're trying to, states that are reducing the gasoline tax, if you will, or eliminating it for a period of time. All of these are challenges that we have. What we've seen is, though, producer prices, the cost of producing items is still going up and is still higher than this. So West Texas Intermediate crude is $110 a barrel now, that's up from about $66 a year ago. Our producer prices overall, didn't mean to do that. Let me get back to the right slide. The producer prices overall have risen 11% since last April. So again, our consumer prices are not rising as fast as producer prices, but it will have to at some point. The biggest gain in the producer price index in transportation prices related to oil prices, et cetera. Transportation costs are up about 20%. And that's two factors. One, it is the cost of oil and gas, particularly oil to make gasoline. It's running through or diesel in this case, but it's also demand for transportation services outstripping supply. We were already having driver shortages before all this shift to e-commerce and delivery and home and things like that. And so we just see pressures on both sides. Demand for transportation services are rising rapidly, and simply the supply is not there. Construction prices are up about almost 20%. Food prices in the production cycle are up about 16%. Crude food prices, so unprocessed food prices, are up almost 50% over last year. What this means is that despite anything that the administration would like to be able to do, the underlying pressures on consumer prices are continuing to rise. And while I think I mentioned in the January meeting that, in my view, producers were absorbing some of that expense and not passing it all on to the consumers, it wouldn't last long, and those pressures are continuing. So I think that at least through summer, where we have all this extra demand from people traveling on transportation and other factors, I just don't see inflation slowing down a whole lot at the moment until we start seeing unwinding in the supply chains. And we can talk about that more in just a few minutes. Here's a big thing explaining both GDP growth that we've seen sustained throughout, and of course, what's happening with consumer expenditures. Now, again, this is annualized data, so just compare. Obviously, 2020 with pandemic year, we had a drop, but look how much we're spending now. We are, and the thing is savings rates are still up a little bit. So incomes have been rising, more people have jobs. Those people with jobs are seeing raises and seeing others. And we're hanging on to a little bit of that money. We're paying off some debt. Remember that the savings rate, things other than consumption expenditures, includes both paying off debt and money that you put in the bank or other savings vehicles. But nonetheless, a lot of spending. And that, of course, is driving prices. One of the things to acknowledge is that the $4 trillion in government spending packages that were passed as basically, I just went blank on the word. Sorry. Things that were meant to drive additional spending. In other words, they were sparks for the economy. Well, we probably overdid it, of course, and that's a blinding flash of the obvious. What we have seen is that extra boost of government spending and the extra boost of government supplying new funds to households at the lower sector. And yes, it was meant to replace some funds, but in reality, what we saw is it just drove a lot of spending and is part of the reason why inflation has been high. Not all of the reason, mind you. And having said that, I don't know that I would have wanted to undershoot it, because undershooting it would have been perhaps even worse if we had allowed that big drop that we saw in the first days of the pandemic, where we had the worst technical downturn in the economy ever, worse than the Great Depression of 1929 or the 1930s. It would have been worse. So Congress overshot it a bit. Oh, and by the way, both parties voted for those kind of things, but of course that won't be the obvious in the political rhetoric. All right, so let's move on to some other. This again is annual numbers, just to show a long run trend of what we were going on. You can see where we, after the Great Recession in 2009, 2008, 2009, the interest rates, particularly the Fed rates, were virtually zero for all intents and purposes, and certainly were less than zero on an inflation adjusted basis. They started bringing those interest rates up a little bit. And then of course we had the pandemic and they dropped back down again. Now we have seen the Fed starting their two-prong attack on inflation. They are reducing the level of asset purchases. They have stopped asset purchases. They haven't started unwinding positions yet. So that's an interesting one to see what happens in the summertime. And now the Fed rates, after that 50 basis point increase that we saw recently, are now standing at 0.83%, which of course is still pretty cheap in the long term. 10-year treasuries are now at 2.86%, and the 30 years are at 3%. What's interesting is that gap between the 10-year and the 30-year. You don't get a lot of extra interest out of extending your risk for 20 extra years at the moment. But you can see how those slides or how those trends are really starting to tick up. And of course, and this is reflected in mortgage rates and a lot of other things that we've talked about. In fact, the mortgage rates, and we'll talk more about that when we talk about local housing, have just been phenomenal about what they've done this year. Not necessarily phenomenal in a good way. Housing overall, new home sales, we kept going during the pandemic. In fact, our purchase of homes increased, and some of that was people who were shifting out of, say, owning a condo to owning a single family home or looking for a place outside of the urban area. That was a little bit of it, but we saw a lot of demand. But we've seen new home sales starting to really tick down. We had a little bit of surge there at the beginning of the year, but it's falling back again. Now we're seeing, I think what we saw there at the end of the year was ramping up, say, pulling purchases out of the first part of the year as people were desperately trying to get in because new mortgage rates were likely going to be rising based on the signaling from the Fed and others. So it was try to get those sales done at the end of the year. And now we're starting to see some impact. If you are a young person looking for your first home and you were struggling last year to find something in this region, the struggles continue, but you've kind of missed a really, really big market opportunity because of the interest rate changes. Existing home sales, again, are starting to fall off. And again, we're seeing some of the impact. We saw some real bounce up as folks were trying to get their deals done before mortgage rates increased. How this is going to level out through the summer, I'm unclear about that. In fact, we are just now beginning our process of our forecast of the regional housing markets that we do for the Northern Virginia Association of Realtors. So there may be some things that we can share with you through the group and through the websites here at NBC, and we can certainly get you some information on that ahead of the next time we do a presentation like this. So let's just have a look and see how we did. How I did. And this is by the way, this is a complete violation of any standard of forecasting. You never really get in, you're not supposed to go back and actually say whether or not you did anything right, but the Fed going to respond to inflation. Well, yep, they sure as hell did. Last year in January, we were thinking in terms of maybe 325 point interest rate rises. Now they're talking about 725-point rises, although that talk is starting to peel back a little bit now. And we've even seen, the 50 basis point jump and talk about multiple 50 basis point jumps. Some of that is, there are folks that are starting to say, maybe they don't need to do, that much of an increase this year, but we'll wait and see. The demand curve still shifting upwards. Consumer spending, those who have money still have money, and it's still looking pretty good. So I think we were pretty spot on about that. The supply chain backups unwinding in the third quarter, fourth quarter is what we were looking at before. And all I can say is we can pray that that is true. That is a huge thing of what's still constraining our market growth. The Chinese policy of zero COVID is being very disruptive. Shanghai has got shut down for about 10, 15 days. That's on the order of billions of dollars per day when Shanghai shuts down to the global economy, and we are connected to the global economy. So while I still think that we can see some easing of that, it's really how this pandemic pops up in some of these new variants that we're seeing. What happens in countries that are producer nations? Do they shut down? Do they plow through? It just depends greatly on what's going to come up. Consumer spending, especially for luxury goods, still strong for most of the year. That was what we were foreseeing at the beginning of this year, and I think that's still true. Starting to see a little bit of softness in some of the markets, but quite frankly, high-end vehicles, the Ford Lightning electric pickup truck, get in line if you want one of those, and wait till next year for delivery. Boats are still selling very well. So those high-end goods are still doing very, very well. The build at the beginning of the year, we said build back better will either be scaled back or dead. Well, I think the answer, we know to that now. Politically, it's not going anyplace. Labor market is tight for skilled workers. Well, yep, and that has not changed. So in inflation, I was talking about 4%. I have to say now it's 6%. So I'll give myself a check minus on that one if I was grading, just in saying, yes, it's going to still remain high, but I think it's going to be substantially higher throughout the year. And that is going to have it will be interesting to see the response that the market or the voters give to that. And right at the moment, it really looks like the Democrats are going to get hammered over that. GDP growth for the year, I said 3.8%. That was before we had a war in Ukraine to deal with. I would say we're probably, because of the constraints in energy markets and some of these other factors with supply chain, we're still going to grow for the year. I do not see a recession emerging during the rest of this year. The risk of a recession next year is certainly higher than what we would have seen a few months ago, but I'm not even sure that that's a certainty at this point, because I still think that the fundamentals are still looking pretty positive. There's some overheating. There is certainly some things going on in the stock market that are way on people's minds. In fact, we can think about that. But quite frankly, my confidence level is not huge. Much of this still depends on, does the Federal Reserve know how hard to step on the brakes? Are they going to slam on the brakes during the summer? Are they going to tap on the brakes gently? Are they going to pause and coast for a little bit? I can't imagine that there's going to be actually some calls from some quarters for them to hit the accelerator. I hope they resist those calls. But let's just say that I think it's a little bit uncertain at the moment, but I still see growth for the year, just not as strong a growth as we were looking at the beginning of this year. The stock market said it was going to be up for the year, but volatile. Well, we've bounced back and forth around correction territory, bear market territory. I think that there were some things there were particularly some technology stocks that were overheated in price anyhow. The whole price to income ratios were getting out of whack, much less price to revenue or profit levels. I've said price to income, I meant price to revenues before. But the stock market volatility, I think, is here for a bit, and we're going to see some wild swings. Having said that, please don't go out and just sell things. I mean, even if you think you're going to retire in a couple of 3 years, there's just little reason, I think, to do that in most cases. There are some overvalued stocks and sectors, but allow them to catch up would be more of a way to go. Having said that, the market runs on sentiment. Does Putin do something crazy, even stupid, even insane? It's possible. We have so many outside factors that are flowing in, but there will be some sectors that will perform pretty well, all of it. So again, will the Fed get it exactly right? Well, probably not. Let's just hope they don't get it real wrong. We're still running through different variances on the pandemic and this move to it being an endemic. We're not done yet. But again, I think that psychologically, many of us are kind of done and we're moving on and we're figuring out how to live with this. A big factor in my assumptions is that the war in Ukraine stays localized, that you don't have Putin trying to do something silly in Finland or some of the other Baltic nations or something or another. I would love to see China backing off its zero COVID a little bit. I think it's starting to really impact their economy, and there's some restlessness going on. So whether or not Xi just wants to prove that he's the strong man and can do whatever he wants to do, regardless of what the populace is feeling or not, I do think that they can back off a little bit, and that will relieve some of the pressure on supply chains. Oil prices will stabilize at a new higher level. I don't see anything that says we're going to go back to $60 a barrel oil, but I could see us pulling back a little bit, but and trading within a range, as the phrase goes. And of course, the big one is, do consumers get spooked? So far, we're a little more concerned based on the expectations index, but we're not greatly concerned. Let's shift now into the Washington economy for just a little bit as we're moving toward getting closer. I hope you are taking notes and writing down questions. We will not have an exam. Thank you very much, but we believe in the value of exams here. Annual job change in the region. Well, as you can show from that dark green line that goes along, we continue to grow, but we have not recaptured our levels of pre-pandemic employment. As we've talked about before, there are some very significant differences across industries, and we'll talk about those in just a moment, but we are generally moving up. Keep in mind, these numbers are not seasonally adjusted, so you see that pattern to the data. I have been very concerned, and I think I've expressed this to this audience before, that the Bureau of Labor Statistics and their measures continue to do seasonal adjustments. And I might argue to you that particularly during the pandemic, seasonal variations kind of went out the window. We saw housing markets really peaking in September, and activity, at least, peaking in September and October a couple of years ago. I just unsure that when you make those seasonal adjustments, if you're not adding more distortion as opposed to helping to clarify what's happened in the underlying economy, that separate than usual seasonal changes. Having said that, these data are not, and we're seeing that growth, and we saw a little bit of a downtick at the beginning of the year, but we've starting to kick back up again. The trend line is still positive year over year, added about 103,000, but we are still something in order of about 66,000 jobs below where we were in February of 2020. So we still have some recovery left to see yet in this region. And if we look at this across, note that Northern Virginia saw, of course, Northern Virginia has more jobs than the other two subsectors, the Southern Maryland suburbs or the District of Columbia. But what I would point out to a couple of things here is that while the number of job growth that we've seen it slow just a little bit in terms of month over year, that up on the right-hand side, those blue sections of the bars, you notice that they're not as tall as they were, say, a year ago, but it's still quite positive. The Southern Maryland suburbs, though, they are really slowing down in their pace of recovery growth. So that's interesting. DC seems to be growing a little bit, but notice those green bars, their size versus during the pandemic and loss. DC is struggling on the jobs front. And that's reflected in vacancy rates in office buildings. Obviously, the restaurateurs and the retailers have all been struggling. Anybody associated with the convention business, we've started to see some what they call full city conventions, citywide conventions, they call them. So the really big ones, we've seen some of those starting to come back a little bit, but it's still a real challenging market in the district. Employment composition, these numbers have changed a little bit. So for example, leisure and hospitality has grown just a little bit, but of course that used to be a sector that was actually above state and local government. So it's still substantially down. It usually was around 4, and sometimes you'd have retail trade and leisure and hospitality. What's interesting about retail trade in this region is the degree to which we're starting to see some folks and some shifting back into brick and mortar type of sales. So in other words, it's not that the losses to e-commerce during the pandemic are permanent, but I don't think we're ever going to go back to what it was before the pandemic. It's just that we are seeing some recovery. And of course, from a national perspective, we got Amazon now that's actually starting to try to, they overexpanded in some of their markets, not necessarily in the DC market where they have a new 600,000 square foot facility that they're building in Stafford. And there's no mention about not still needing that, but other markets, they expanded their warehouse holdings a little bit too aggressively. And so they're starting to look to sublease some of that space. And they're also actually laying off some workers in some markets. Though again, I don't think that's happening much in our area. You can look down through some of these others. But as we talk then about what's going on here, well, the federal spending cycle, and these are early figures, obviously, for 2022, haven't updated those recently, but the federal spending cycle is still high. Certainly, there's going to be less of the stimulus spending. There is the last estimate I saw, and I don't remember if I mentioned this in January, but the last estimate I saw, which has been a few months ago, is that there remains about $500 million in authorized recovery spending monies that have not been allocated yet. So there may be some of that, though quite frankly, the administration is under pressure not to do things that would be seen as potentially inflationary. So there's a real dilemma about what's going to happen with that money. Having said that, federal spending for defense is going to be up. There's some things going on about Ukraine. We've deployed more troops into Europe, that are on exercises and things like that. And all of that, remember, said that the great thing about our region is if there's federal spending of any kind, even if that spending winds up in other states, whether it's defense or non-defense, whatever, we have so many of the contractors in this region that we get to take a little piece off the top as the money leaves the area. So I continue to see that going. So the federal sector and the contracting sector is still going to be quite strong for us. If we look at these other sectors, so the professional business services, which is where most of the contractors shape up, we saw, year over year job growth about 15,000 in April, and that's 12, almost 13,000 above the pre-pandemic level. Education and health services, like at the national level, growing, but still below the long-term trend. Federal government has reduced. There's some artifact to that, but still a little bit above the pre-pandemic level, interestingly enough. State and local government, same story. Well, state government's actually expanding a little bit. Leisure and hospitality added 58,000 jobs year over year, but still 30,000 below. So that's some of that kickback. And that's keeping in mind, just for perspective, prior to the pandemic, we were on a trend that would say that pretty good job growth in this region in a year would be net of about 50,000 jobs. So, while we're having, last year we've added 103,000 jobs, year over year in April. That's spectacular growth for us. It suggests that under a normal conditions, we still have a ways to go for leisure and hospitality. And you can see some of these other sectors. I think it's interesting to note the downturn in financial services, which I don't have data on this. So let me clarify that this is speculation, but my thoughts are that we are seeing some local impacts of two things. One, the number of local branches that simply are not going to stay open after the pandemic. They're not going to be walk-in shops. There's going to be fewer of them. So I think that's something that's going to continue. And I think that we are seeing some job impacts of local consolidations from mergers and acquisitions in the local financial industries, particularly in banks. So that's where I think most of that is. The rest of these are relatively small sectors. It's interesting that manufacturing declined a little bit. I'm not so sure I'm overly worried about that, because I think that some of our key core technology manufacturers, Micron, for example, they're doing quite well and will continue to do well. So focusing in on the professional and business services, as we talked about, you can see that job trend growth over time. Certainly from a regional level, we had those downturns, but I'm going to go ahead and jump to the next slide so that we can talk about that differential between professional, scientific, and technical type of services versus administrative support. So you're thinking about personnel agencies, services to buildings, security services, janitorial services, waste management services, those kind of things. That's where it took all the hit. Now, from an economic perspective, that's a relatively lower value added sector of the economy versus professional, scientific, and technical. One of the things that's really interesting, if we subdivided this out and looked at the regions, the sub-regions, Northern Virginia throughout the pandemic did not lose any professional, scientific, or technical services jobs on a net basis. Not saying that there weren't some job losses, but there were other job gains that offset those. So they stayed, it was small gains, but they never went negative in that sector. We saw negative growth in both DC and in Southern Maryland suburbs. But as you can see, since that period of time, as folks have started to come back to buildings a little bit and businesses have shifted their operations to at least more hybrid operations, we're seeing some of that come back. Federal government, we talked about it a little bit more. I don't see that's going to be a major change in growth. I think we will continue to see spending out of this Congress, as well as out of the administration and things. Let's face it, Congress spends money. It's what they do well. It's what you get is what are they spending money on? And as I mentioned before, whatever kind of spending they do, we gain a little bit on this region from it. And then this one, what I wanted to do here is just bring in, this is not year over year, this is just our most recent trends. So we actually saw a little bit of softness in retail trade. I think that's very interesting. I'm going to monitor that carefully to see what happens on in the future. There were some of these other factors that were surprising. For construction to actually go down between March and April, I think is a really interesting phenomenon that I'm going to watch carefully and see what's happening there with the trend. Normally you would see, you're coming out of wintertime, you would expect more construction activity. Although quite frankly, let's face it, our big challenge right now is if any of us are wanting to have construction type work done, remodeling work done, anything, it's very hard to find folks that are doing it just because of a shortage of workers and all. So for that to actually decline in terms of employment counts is pretty interesting. The unemployment rate in the area, Northern Virginia back down less than 3%, 2.4%. I mean, you know, that there's not a lot of folks out looking for jobs. And let me tell you that, and I'm not, that's kind of, again, one of those blinding flash of the obvious statements. You folks, many of you are experiencing these challenges. What's interesting is that gap between the Maryland suburbs and Northern Virginia. That's unusual for that gap to have merged like that, as you see. And you can see those lines historically, the little kind of goldish line that you can see a little bit over the blue line there, that's the Southern Maryland suburbs. And it's a much closer relationship over time with the green line, Northern Virginia, that more recently there's been a significant gap in that, which is interesting. So how are we doing versus other economies? Well, basically, thanks to Minneapolis and their continuing challenges over race relations and all of that kind of stuff that just seem to have all of their attention still riveted on those very fraught topics, is without them, we'd be dead ass last. So we've seen that. Now, having said that, that doesn't mean we don't have stability, but some of the growth that we've seen, Atlanta, Dallas, Houston, Miami, it's phenomenon. I've been to Dallas once this year. I'm going in a couple of weeks. I have an uncle that's turning 90, so we're going to have a celebration for him. Careful with lots of protocols and being everybody, you know, testing before we go there and all that stuff. But nonetheless, it's phenomenal, the growth that you're having. Remember, I said that in good years, really great years, we can see $75,000 new jobs in this region, and a good year is 50,000 or whatever. Dallas Fort Worth, which of course they're a little bit bigger economy, they're a bigger region than we are physically and total population. They added 110,000 jobs last year. I think the number is well over 100,000. So it's really, those places, some of these places are going crazy, but we're pretty stable. And of course, the thing is that if we do go into some kind of a recession in 2023, I can promise you that our position on this chart will skew a lot further to the right. But we have slipped down a good bit in the last year or so. Looking at the District of Columbia, I mentioned this earlier, so I won't go into a lot of detail on this, but while we've seen some, if you'll notice over the bar charts on the right side, we've seen a little bit of acceleration growth that also appears in the green line. So you notice that it's kind of jumped up a little bit here in the last several months. So that's looking a little better. That can be tied directly to return to office, I think, and the reemergence of tourism travel. So, you know, those are good signs, but we're a long way from recovered yet, as you can tell by that gap between where we were in early 2020 versus where we are now. So that, you know, of the regional gap of about 66,000, 40,000 of that is in the District of Columbia. That gives you some perspective. And when we're looking at the sectors, it just shows up there. So a little bit with the return to building. So I think this is some of that administrative waste management kind of sectors of the professional business services sector. And then of course, leisure and hospitality. That's where the big changes are there. If we look at the Southern Maryland suburbs, again, a little bit of a jump up, you know, immediately after the recovery, but a little bit of weakness in the last few months that we've seen. So it's a little bit of an interesting phenomenon going on. The gap between getting them back to recovery is not as severe as we've seen elsewhere. But nonetheless, Southern Maryland, particularly Montgomery County, is being challenged a little bit, and from a competitive standpoint with Northern Virginia predominantly. And we look at this, so job, you know, with the exception of the financial sector, job categories pretty well spread across, with the leader being leisure and hospitality. Notably, though, state and local government has a bigger impact on their total employment picture. In Northern Virginia, you can see we are not quite up to where we were. We almost hit that peak a little bit earlier in the year, and we've dropped down a little bit, but we're still seeing pretty good growth, if you will, going on. So this is, you know, we're moving along, we're chugging in Northern Virginia, and by the sector, we are also picking up some of those leisure and hospitalities, but notice that the professional business services is picking up too, and that's both sectors of that, both the professional side and the administrative side. Let's move now into some housing market trends, and let's think about this because that's still everybody's mind, what's going on. And this is the number that just continues to amaze all of us that monitor the housing market. We've gone past seeing the limbo, how low can you go when it comes to inventories of existing homes. Keep in mind that these inventories include pending listings and active listings. So in other words, if a house has already got a contract on it as a pending sale, it still shows up in these numbers. So the actual number of homes that are available as an active listing waiting for somebody to show up to buy it is even a good bit lower than what we're seeing here. But look at that slide down. Across this entire region, a population of well over 6 million people, we have less than 14,000 housing units for sale in the month of April, down from 21,000 last year. This is really interesting. And some of this may be tied to what's going on with mortgage rates, because the thing is, if you sell a home, unless you're leaving the region, where else are you going to buy? With the constrained inventory. Interestingly enough, we had continued to see sales numbers climbing. In fact, sales numbers, are finally starting to respond a little bit to the slack inventory. Now, what happens, with inventories declining over several years, yet sales staying, growing slightly, staying somewhat flat, or surging up a little bit during the pandemic after those initial shutdowns. What's happening here? Well, that just means that the days on market, the inventory number is an end of month snapshot. This is a collective of all the sales within a month. So what it really indicates is, as the sales keep up and the inventory gets lower, that days on market gets smaller and smaller and smaller. The traditional number in real estate, tradition, and we may never go back to tradition, or at least not for a long time, is that having a 4-month supply. In other words, your rate of sales would suggest that you could sell all the properties on the market at a given time within 4 months if the rate of sales stayed up. That number is closer to about 15 days. And of course, and that's also when they say the balance market, balance between who has the power, the seller or the buyer. Seller is still very much in charge, and we're seeing that. And we see that with some of the crazy deals that are being done now with some housing. If you can imagine, I think I mentioned this maybe I don't remember if it was during the formal presentation or in our conversations of the last session, but think about that last year you had people, and this is more about building a home, but there were some folks in this nation who were buying custom built homes that were being sold without a specified price. The price was going to be whatever, was going to be a contractor's fee on top of whatever material costs are. And there was no guarantee of delivery time. So you didn't know when you were going to be able to move in. You didn't know how much it was going to cost, but you were going to have this person build the home for you. I'm not sure that my economist trained heart could ever do that under any circumstance, but it's a really interesting phenomenon. But the home sales, as you can see, starting to come back a little bit. It's going to be interesting to see what happens as we get deeper into the summer. But April is usually a very peak month. That's where we see one of the peaks of the spring season emerging. And this is some of the same data just expressing, so we're falling off. This was the interesting phenomenon, if you will, look at 20 and early 2021, where we just saw a surge of activity after the initial downturn of housing market activity. No industry adapted faster to the remote, viewings, remote closings, all of that, employing technology to keep their industry active. The real estate transactions market adapted faster and better than any other sector of the economy, hands down. And then you see the building permit data going on now, where yes, we saw a little bit of a rise, and we're seeing some of these permits, but we're way behind. If you just think about the demand and growth that we've had and demand for housing that's out there, we need to be building more housing units. Of course, for some of our communities, there may not be a lot of place to build more housing, but we certainly see the expansion that's going on elsewhere. But again, this number is not as high as we need it to be. The net effect of all this is what's been going on with price. And then here recently, we just saw a really big jump. It's going to be interesting to see if that jump holds. You can see we have these seasonal patterns that emerge in price data. These are median prices, but look at that surge in the last one. In April, the average home in this, or not, sorry, the median home in this region sold for almost $600,000. We've never seen anything high like that. In fact, you go back to some of the bad old days or whatever, we had the peaks and the fall offs or whatever. We're a good bit above that. Obviously, there's some inflation adjustment that you could do on those numbers, but this is really we're priced out of market for many home buyers at this point. Add to that not only the sales price going up, but the mortgage price. I kind of wonder if this spike is in part related again to people trying to close deals, get a house, bought prior to prior to mortgage rates going up, and they were, if you will, responding to that money as they were looking at long-term cost as opposed to the short-term cost. I hope home buyers are doing that kind of detailed financial analysis that they would come to that decision. I'm not sure if they are or not. So let's take a few minutes then, just as we close out this segment, to have an update of what we're doing and see how we're going. So here's a big thing. We actually saw some population loss. This is some data that was released after our last presentation. This came out just a month and a half or so ago. This is the population estimates program from the U.S. Census. The year dates down there are a little confusing. For this program, what you're measuring is population change from July 1st of a given year through June 30th of the following year. So these data cover July 1st, 2020 through June 30th, 2021, the most recent data that we have. There's usually about a 9-10 month lag from, getting this data. And what you can see is that we experienced a surge in domestic outmigration. We still saw some international immigration. We still saw some natural births, so some natural growth from more births than deaths, but all of it at a lower level. And note how much, and of course, this is because of the COVID restrictions in part, international migration dropped down, from 46,000 the previous year to 12,000 in this period. But note the tripling almost of the number of people who left this region, who are living here and left to go live elsewhere. And that's on a net basis, right? That's taking account some people moved to the region, but almost 72,000 more people left this region that year. Some of that certainly can be attributed to the pandemic. What I am concerned about is even with that level where population growth declined, you saw that demand in the last couple of slides where housing demand was still rising, prices still rising, rents are still going up. Rents are still up around 16 to 18% in this region year over year. So all of this is, we're seeing more demand, even under a condition where we actually had a little bit of a drop in total population. Therefore, we have some real issues that we need to cover. And with the ability of companies to actually administer workers who are working remotely, you gotta believe that we have a competitive threat emerging about keeping young families that have become frustrated at the lack of affordable housing. And when I say affordable, I'm not talking about low-income housing, I'm talking about workforce housing. The frustration that folks in being able to find workforce housing where they can go elsewhere. Now, mind you, many of these other areas, Dallas, Atlanta, some of those are rapidly kind of catching up with us on price, but still there's a substantial gap, as many of you well know. So our regional conditions, travel's coming back. We had about 19 citywide events booked this year. That's great. Domestic has rebounded more quickly, as we've talked about. We are seeing an uptick in COVID cases, and it just doesn't seem like a lot of people are carrying. Who knows? I think that we've got 7 more months before we're going to enter a period of extreme fiscal obstruction. I think that the Senate and the House will be controlled by Republicans if things keep going the way they're going. Talent we're not getting we're getting lots of talk about talent retention. Well, we're talking about talent attraction from elsewhere when talent retention should be much more of our focus. And that whole issue about the hybrid remote work, which we can talk about otherwise. Housing, rents, this is, we talked about this. It's just really key. But one of the things that I think is also an issue from a policy is to start looking at these investor ownership groups of housing, where it's corporations that are buying up, or REITs buying up ownership in housing that's actually constraining our market opportunities for people that want to own a home in this region. Federal spending, not helping inflation, but it keeps us going. To say that we want to see less federal spending is actually kind of a poke in our own eye, if you will. So but that, I don't see anything that's going to say federal spending is going to lower. Small business funding is going to be more challenging. There are still going to be businesses impacted by the pandemic, and I see the ability of Congress to agree to expand these programs further that have been helping businesses through is probably going to go away, particularly now that the news cycles are coming out about fraud and people that misuse the money. Job growth recovery continuing, as I suggested, but I think it's going to be a little bit of a pace. So federal money flowing, yep, still going to be there. Talked about the pandemic funding that's still left. Leisure travel looking strong, yep, still going on. Business travel is actually improving, maybe a little bit more than I thought it was. So I'll give myself a check minus on that one. The market struggles, if you're not in Tyson's, Reston, or Loudoun, and you're trying to lease office space, I think you're finding things a little bit challenging, and that's what we were expecting. The Boeing, gee, we didn't foresee that one. We can talk about that. Actually, I saw where somebody has a question about that, and we'll address that in a little bit. Labor market, it's still tight for skilled workers. Certainly, employment growth, 75,000 for the year, and I'm still kind of sticking with that. I think that there's some downside risk to that number, but I think we can still achieve that number year over year. So can we leverage the Boeing decision? Again, that's for more of a conversation that we can have here in a few minutes. Will Metro get its act together? And at this point, I have to say probably not. How can you speak to the idea that they allowed 70 people to be driving trains whose certifications had expired? I mean, that's inexplicable. And does that hurt talent attraction? If you don't have a well-functioning transit system in this region, think about what traffic is like on 95 these days. That eventually hurts our ability to attract talent. Federal government rules on hybrid remote, a little bit of a zero-sum game that we have going on there, I think, with the federal government. But quite frankly, it looks to me like most of the agencies are not going to fight the fight of allowing workers. Remember that the general perception of the country is any federal worker are slaggards. They don't do jobs. They don't work hardly at all. And if we let them work from home, they'd just be mowing their yards, right? So I think that this is a fight that the administration is not going to take on, which means that that's going to help managers at some of the contractors, have a position to say, we require you to come back to the office because you need to be with your federal customer. Approaches to housing policy, all sorts of things. We can talk about this later, but are you aware of some of the stuff like, for example, going on in Arlington of trying to do away with single family zoning? It's an interesting phenomenon. The region will become more attractive. We have histories of having domestic outmigration in terms of patterns, except during periods of national recession. So it's really kind of interesting that we actually, if the country went into recession, we'd probably be pretty stable and would be looking pretty good comparatively. Interesting. So with that, I'm sorry, I'm a few minutes over our time, but we want to allow plenty of time for questions, and we can adjust the rest of the schedule. So let me then turn it back to our host, and I'm going to stop sharing the screen so we can see people's faces.
Okay, great. Thank you so much, Dr. Clower. I think you answered several of our questions, but I just want to go through and maybe do a recap for some people. Will there be an end to supply chain issues in 2022? If this is a test, I think you said it has a great impact on China's COVID policy. So we're hoping third quarter, fourth quarter, maybe supply chain issues get better, but that's what I heard. Did I get it right?
And that's it. So the short answer to the question is no, they're not going to be over in 2022, but we are hoping that they're going to be better.
Right. Okay, and then leading on from that, you mentioned, electric or car manufacturers and, the supply chain issues. A lot of car manufacturers, the way that they sell cars and the demand is high. However, supply chain also plays a part in that because a lot of car manufacturers get their parts from China. So how do you see that having an impact?
Well, certainly that you have the supply chain effects going on. But one of the interesting things that we're seeing is it goes back more to the inventory models. Electric car manufacturers have always been on kind of the pay part of your money up front, a deposit, and then when the car is produced, then you buy it. But that means that there's no inventory carrying cost at the dealership. There is a potential project that I'm being asked, and maybe we'll have a session on this, or by January we'll be done. The disruption in the whole way we buy and sell vehicles that's represented by the electric cars, because all of them want to do what Tesla's done. Tesla doesn't have showrooms; they have factory stores. No
Right.
service centers, by the way, too. If you own a Tesla car in Utah, there is one place in the entire state you can go get your car worked on.
Well, I'm in California and we have a lot of Teslas and that leads to, with electric cars, a lot of manufacturers, you've seen Ford and the cost of electric cars may come down because there's lots of more electric car manufacturers and price points. Tesla's not the only option. So how do you see that impacting, manufacturing and supply demand?
So there's a couple of factors going. Assembling an electric vehicle takes about a third less labor than an internal combustion car, just fewer moving parts. There's also less until the battery starts squirreling out or your computer programming starts glitzing up on you. There are fewer moving parts, so there could be some substantial disruption. However, given demand that we've been seeing, and we have these companies and the federal government getting more involved through the climate initiatives of directly supporting the placement of charging stations and things like that. I don't know that it's, I think that the car manufacturers could wind up making even, excess profits, or when I say excess, higher levels of profits, right, as some of their costs come down. The big question with the electric vehicles, of course, remains the batteries, because it's not just the computer chips, it's the materials that are used to produce the batteries. And then what do we do with all these batteries after they're spent?
Right, exactly. Okay, so leading on for that with supply chain, and we talked about, you talked about inflation rates going, how high will they go in 2022? And do you see more interest rate hikes by the Fed? And then we had another question that came in. Since the Federal Reserve has very smart economists, do you think politics will impact their decision on interest rates?
Okay, so let me do my what the McConaughey kid from the Home Alone thing. Politics by the Fed? No, that could never happen. There are smart economists there, but the fact of the matter is there is no statistical model that helps us explain every nuance of everything that's going on. We can't model in Putin being crazy.
Right.
We can't model in a megalomaniac in charge of China. There are things that you can't, that you can't account for. Having said that, the Fed also, it almost reminds me a little bit of the dilemma that Comey faced at one time of what do you release that one way or another could affect an election? And by doing nothing, you can affect the election.
That's very true. Very true.
It's a real challenge. But having said that, I don't think the Fed's going to get it exactly right, but I wouldn't expect them to. I don't think anybody can get it exactly right. And maybe they get lucky and it does, but I could see very much where the pressure now, it just depends on, what the scale on. We're still creating jobs. So that's not so they don't have that pressure. I think the pressure has to be more about the inflation. So I expect interest rates continue to rise. They may just not do 350 basis point rises. It may, they may moderate that pace a little bit.
Okay, all right. Well, I'm not letting you off the hook yet on these questions about with the war in Ukraine and Russian sanctions have been blamed for high gas prices, baby formula shortages, and looming food crisis due to wheat and fertilizer imports. So how much of these crises are due to the global economy versus the Biden administration's green policies to shift the way US consumers buy goods?
Yeah, that's kind of, is there an answer C, all of the above? Because one is there's a lot of it that is still global forces, they're doing it. We operate in a global marketplace. We can't isolate ourselves even if we wanted to. Sorry, for those folks on that, that support the previous president that wanted to say, we can, shut off stuff because these trade sanctions don't work either for the economy. There are some policies that I am continually amazed at, the ones of us requiring ethanol to be used, that, is a farm subsidy program effectively, where you're diverting corn from fuel or from food to fuel kind of thing. I certainly think that it would be wise to unwind some of that. Now, maybe I'm a little bit prejudiced because I own a boat and boats do not do well with any level of ethanol. Okay. So, there's I'll admit to a personal, but no, I really have, if you want to subsidize farmers, then be clear about it, be transparent, and just write them a check that everybody can see how much it is. This stuff of subsidizing it through fuel prices is a different thing.
Okay, so I'm going to switch now because we do have several more questions, more geared towards the local economy and what you sort of talked about and touched on. I think that's more important to everyone on the call today. So many of your slides show an increase in jobs. Does that mean that the overall population in our region is increasing? And do you have a breakdown of ages on the job growth?
No, I do not have that. And that is something that we could probably look at, but we would have to look at it in arrears for about 2 years. That would come out of the American Community Survey. And of course it would be estimates, but that would be what we call the microsample data that would, and so we could see that, but what we would be looking at right now would be 2019. And I might argue that 2019 doesn't tell me a lot about what's happening right now.
That's very true. Okay, so, one question came in, and I thought this came up about, you talking about the region and housing prices and the demand and, things on the market, and then REITs buying up property. So this question relates to that. About the work from home revolution's effect on real estate. Do you have any prediction about where will all the real estate capital go? Will investors still turn their capital toward real estate? Will the buyers continue to snap up industrial assets and housing, both single and multifamily, or alternative properties like data centers, self-storage facilities, and studio space to produce streaming content and student housing will be new real estate investment instruments?
Wow. So that's like that movie that Rodney Dangerfield did. I have one question for you in 72 parts.
Right.
So no, it's a very good question, and there's lots of stuff in there. So first of all, from the perspective, I think that if you are the owner of a Class B or C office property, and we have millions upon millions of square foot of that space coming onto the market for lease in the next, as leases expire over the next 4 to 5 years, I think that you're going to be very constrained. We are looking at adapting, that we have a couple of, I think we can call them more than pilot projects, but projects to convert older office spaces into mixed use. So you have some apartments and, condos, and then you have some retail and stuff like that. I think there's going to be some of that. The industrial space, certainly demand for, I don't see any slackening of demand for data centers, particularly, Loudoun, Prince William County. Montgomery County would love to get a little piece of that, but they don't really want it that badly because they're not talking about the Western agricultural zones, and the tax policies are still not favorable. Virginia tax policies are our biggest advantage on that. But I continue to see that growing, and it will spread further south. I don't know about how much further west it will go because it seems that Fauquier County doesn't really want to play in that space too much. But I see that going on. There's going to be other cases that we've seen, just like Amazon did, of some businesses that maybe overinvested in some industrial space, but there's not a lot of that kind of industrial space directly in the core metro area anyhow. So that's more of something that might slow some of those markets about in the fringe. One of the things with the housing stuff, though, that is a real game changer, interesting, is this proposal in Arlington where they're talking about doing away with single family zone, that depending on your lot size, you could, at your choice, choose to rebuild on the same footprint of your building up to 8 housing units.
Wow.
And so think of what that would do for attracting investors. They would say, I can create, 4 or 5, smaller units on a 1970s era urban lot, kind of thing. So there's a lot of dynamic. I do think that I still think that housing, well, as I said, even at a time during when the technical estimates tell us that the population was declining, housing market in this area was it booming? No, it was growing strongly. I don't know if we hit boom or not. I don't know exactly what a boom is, but it doesn't feel bubbly like it did in 2005, 2006, kind of thing. But I think that we will continue to see investors flow into that. And I think we'll continue to see international investors investing in our mortgage markets. In other words, mortgage rates have gone up a lot. And, yes, they're at the 5%, but I see enough demand out there for those products from international investors. As the U.S. is a housing market, it's a great place to park your money while the rest of the world goes crazy.
Well, and we see that with a lot of cash, people paying cash for homes all over the country. So it's a good investment. Well, I want to be cognizant of our time. It's 1:33, so we want to open it up to everyone. So we're going to promote everyone who wants to stay on the call as a panelist. So you can turn on your camera